Snap Projections is very flexible in terms of cash flow management. You can easily use the default settings to save a ton of time, or you can quickly fine-tune the projections to specify your own cash flow preferences. The acronym CFM stands for Cash Flow Management. In the years before the CFM start age, Snap will assume any surplus cash is spent. But beginning at the CFM start age, you can enter a desired base expenses target amount, and Snap will automatically withdraw from the assets to reach this target. If there is surplus cash, it will be automatically saved to the financial assets following a default contribution order. In Justin's projections, the automatic cash flow management starts at his retirement, which is the default setting. Before retirement, we don't need Snap to make automatic contributions or withdrawals from his accounts because he knows what he's going to save. We want the software to assume he spends the rest, and this is typically the case for most people. But at retirement, we've entered the desired base expense value of $48,000 a year, and Snap automatically withdraws from the accounts. First, we see a withdrawal from the non-registered account, then the TFSA, and then once the RIF minimums start, the TFSA continues to have withdrawals, and then finally, only withdrawals are coming from the RSP. Snap's primary objective is to maximize the longevity of your client's portfolio by minimizing or deferring tax liability. This is Snap's default logic to maximize your client's cash flow during retirement. In some cases, this strategy won't align with your client's objectives, so it's simple to create your own decumulation strategy. One method is to use withdrawal overrides. For example, I can enter a withdrawal of $20,000 a year from the RSP, copy that down to age 100, and run this scenario. In this case, Snap will take my override as the first withdrawal. Then, if there's supplemental cash required, it takes it from the non-registered account and then the TFSA. When there is RIF income required, even though we'd entered the $20,000 withdrawal, now it's forcing at least the RIF minimum. So I'm going to clear these overrides, stop software from doing those manual withdrawals just by using the clear override checkbox. Once I run this scenario, that will disappear and we'll go back to the default logic. So next, a second method is to go up to the financial assets header, click the gear icon, and we'll see the settings related to cash flow management. I'm going to show the CFM order column for this scenario. And now on the planning page, we'll have additional section called the CFM order with both contribution and withdrawal columns. Before the CFM start age, there's no automatic contributions or withdrawals, so they're dashes. But after the CFM start age, in retirement here for Justin, the default withdrawal order is non-registered TFSA registered. What I can do here is change that to registered, non-registered TFSA. I could do it for 1 year. I could do it for multiple years. Let's change it for all the years going forward. Running this scenario will recalculate this for me. And now we see these withdrawals happening first from the registered account until there's nothing left, then non-registered, and then TFSA. I'm going to change this back to the default order, non-registered, TFSA registered. And then we're going to talk about contribution logic. If Justin perhaps knows his budget is $48,000 a year right from the beginning of the projections, we can start the CFM right here at the first year. So I'm just selecting the dot for the CFM start age in the first year of the plan, clicking run scenario. And now we have a base expense of $48,000 a year. And there was going to be some surplus money. So based on his employment income, and after he's paying his taxes and CPP and EI, he's making those contributions that we specified, and he's paying his mortgage. There's some money left. It's automatically being contributed to this non-registered account. That's because we already have contributions happening in the RSP and the TFSA. But if we were to clear those contribution overrides and let Snap use the default logic, contributions will first go to registered then TFSA, and then non-registered. So SNAP is making a contribution with the most that it can up to the contribution room and whatever the surplus cash is that year. And then once the room has been maximized and there's still surplus cash, the contribution will go into the TFSA. So this is a totally automated projection just based on the base expenses and other expenses in this scenario. And we're just having SNAP do all of these automatic contributions and withdrawals for us. But perhaps you'd like to control all of the contributions and withdrawals. What we can do there is click the gear icon at the top of the cash flow management column and deselect enabling the cash flow management for this scenario. And so now there will be no automatic contributions and withdrawals except for the required RIF minimums. You would be responsible at this point to enter any savings that he plans to do or enter any withdrawals from the other accounts that he would plan to do. So this could be very helpful in a case where a client would just like to know how much income could they expect after tax based on just government benefits and perhaps a pension plan like a defined benefit pension income each year. So as you can see, there could be many options that you can investigate. You might wonder which is the best one. So join me in the next video where we will discuss how to compare scenarios.